Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, it is 4:30 p.m. here in New York, so we're going to get started. Welcome to this afternoon's webinar. Today's session will be hosted by Jason Ayres, who will be teaching us about simple spread strategies to trade your FX options outlook. As many of you already know, Jason Ayres is president and founder of OptionSource.net, which provides quality education and opportunities in the stock and options market for over 5 years now. OptionSource.net is one of Canada's leading educators in trading stocks, options, futures, forex, and commodities as well. So at this point in time, we're going to go ahead and turn it over to Jason, and we should have some time at the end for Q&A.
Good stuff. Thanks very much. Again, just maybe a quick confirmation that the audio is indeed working from folks that are joining in online. I know there's a number of individuals that have just signed in, so see we're getting a confirmation. Great, thanks everybody. So as mentioned, we're going to take a look at some simple spread strategies to trade our FX options outlook. And I know there was a question with respect to whether or not this was going to be an introductory class or whether or not we'd be looking at some advanced techniques and topics. Well, we typically look at spread strategies as a little bit more of an advanced approach to utilizing options, because there's definitely some intricacies of the strategy that you need to be aware of before you just go ahead and start applying them. I think what might be interesting, particularly to Victoria, whom I know quite well, might be the very product that we're looking at applying these strategies to, the FX options. Products that are available through the ISE are really an interesting way to participate in an outlook on a particular currency and its value against the U.S. dollar. And so on a day-to-day basis, when we cover our market analytics, we're typically referring to these particular products. So it might be a great opportunity to just learn about a new product, and reinforce some of the important considerations for applying spread strategy. So on that note, let's just move forward here. Of course, Katrina's already indicated a little bit of my background. I'm a derivatives market specialist by designation. We've had our online component of the business running for about 5 years now, but our live programs have been running in Toronto for the last 11 years. So we've been around for quite some time, and we're very happy to be working very closely with the International Securities Exchange. Great group of people there, and great products to trade. Now, as always, we're going to talk about some relevant market observations today, and I just want to reinforce the importance of understanding that the observations that we're going to make are for educational purposes only, and we want to make sure that everybody understands the risks involved in trading options, and not just options, but of course any market for that matter, and make sure that before you click any buttons in the live environment, you spend some time in the simulator clicking a few buttons and understanding how the strategies work before you go ahead and actually do them in your live account. So just a quick little introduction to the ISE FX options family. There's actually quite a robust selection in terms of option contracts that you can utilize that will give you exposure to the U.S. dollar's strength or weakness against a variety of different currencies. And one of the great features, I believe, of these particular products is the fact that they're accessible through any standard options broker. So rather than the typical approach to being able to gain exposure to the currency markets, which is actually opening up an FX trading account with an alternative broker, you can actually access this market through any standard brokerage account that you're utilizing currently, in which you are able to trade options. The other interesting characteristic is that these options are in fact cash settled in U.S. dollars. So there's actually no underlying product to deliver or to receive delivery of. The settlement of the option contracts are essentially based on the difference between, of course, the strike price that you've selected and the settlement value of the particular pair. And as a result, because there's no underlying security, they are what's referred to as European-style exercise, which means if you're an option writer, which we're going to be talking about this afternoon a little bit in terms of being creating credit spreads, you don't have to worry about early assignment on your written option contracts. The written contracts, if you decide that you want to write naked options, if you will, are settled again based on the difference between the strike price and the settlement value of the option contract. And if you don't want to take action, or if you're worried about an option contract that would typically be a good candidate for early assignment as a writer, you don't have to worry about that, because that's not a possibility with this particular style of option settlement. And as you'll see tonight, or this afternoon, they can be traded as spreads. So essentially any typical option strategy that you would utilize in the equity world, you can actually apply to these ISE FX options. The only one that you can't, of course, is a covered call strategy, because again, there is no underlying deliverable to utilize within that strategy. So let's move forward and get down to business here. Just a quick note before I do so about the weekly outlook that we provide for the ISE. Anybody that is interested in gaining a little bit of insight on a weekly basis as far as our technical overview of the currency markets and expectations for some of these pair values, you can actually visit the site fxoptions.com. And you'll see that we have on a weekly basis a technical overview of the currency markets and of the FX options pair values that you can use as a tool to maybe formulate some of your own insights and to give you some ideas as to how you might trade these particular contracts. And what we really do is we just apply some simple technical observations to a price chart to identify a probability of direction. We more or less try to illustrate to any of the viewers that are watching just certain clues that will help you understand where might be an appropriate place to enter a trade, to buy a call, to buy a put, as well as some ideas in terms of locking in profits and cutting losses, et cetera, et cetera. So the one consideration that we always like to bring to the table, and it really doesn't matter what market you're looking to trade, is just keep an open mind with respect to your directional bias. And as I always say, and I know there's a lot of our members online right now that are joining in that have heard me say this before, you know, as a trader, I reserve the right to change my mind at any given time. So in other words, if things aren't lining up the way we expected them to line up, then ultimately we have to be prepared to change our minds and take another stance. And that applies to trading these FX options as well. We want to formulate a bias. We want to be able to implement the strategy. But at the end of it all, we want to know, we want to be able to cut our losses appropriately if indeed things aren't happening as expected. So let's get in and just take a look at really the considerations for why we might look to create a spread strategy. Now, typically, spread strategies are more popular during periods of high implied volatility. Now, at this point, when I take a look at the implied volatility versus the historic volatility that we can actually access at fxoptions.com. When I look at that relationship between a number of the different pair values available to trade, I actually can see that the implied volatility is not really at historical highs. But nonetheless, in the event that call and put options are expensive, or in the event that we want to reduce the cost of an option contract that we believe is expensive, what happens is we can utilize that outlook, number one, to consider writing those option contracts to collect a higher premium, or number two, because those option contracts might be a little expensive, the risk and reward of being long a call or a put is diminished. So we can utilize these spread strategies as a way of offsetting the cost of more expensive options contracts. And as I said, typically options become more expensive during a time where there is an increase in implied volatility. And the rationalization there, of course, is that as a market maker who has to take the opposite side of an options trade, if they believe that there is going to be a substantial move in the underlying security, and in this case in the underlying pair value, then what they need to do is they ultimately need to increase the premium that they're collecting in order to take that opposite side of the trade. So what happens is for buyers, we're looking at perhaps paying a little bit more than we expected. So we want to actually be able to offset the cost of the more expensive option contracts. So it becomes an ideal time to consider debit spreads. Now, as I mentioned, even though the current state of implied volatility on many of these pair values it's closer to the historical highs, but not quite there yet, these debit spreads offer us a great opportunity to lower our cost basis, lower our risk exposure, and lower our break-even points. And for smaller accounts, because we're putting up less capital to participate, it frees up additional capital, of course, to implement it in other areas of our trading plan. So debit spreads, to start off very simply, we're going to look at bull call spreads. And no surprise, the outlook for the strategy is bullish. So ultimately, we need some mechanism of establishing a directional bias on our particular pairs, and we typically look at price charts, and as I indicated with our weekly outlook, we try to give some of that insight. But if we happen to be bullish, what we want to do is we want to buy a call option. If we believe that call option is a little overpriced, or if we want to kind of mitigate the cost of that call option, what we'll do is we'll sell off an option contract at a higher strike. Now, of course, when we sell that option contract off at that higher strike, we collect a premium. That premium offsets the cost of the original position. But the trade-off, of course, is that we cannot profit any further than that higher strike price that we've sold. Now, of course, no surprise, we have to implement this strategy utilizing the same pair value. And in this particular scenario, we're going to use the same expiration date. Now, you can get fancy. We can do calendar debit spreads whereby we're buying the longer-term option contract and selling off shorter-term option contracts. There's lots of interesting things that we can do. But for now, to keep it very simple, we're going to use the same expiration date in order to make it a little easier to understand. So here's a snapshot of the EUI. This is a chart. This is a daily chart that reflects the U.S. dollar strength and or weakness against the euro. Now, as of late, it's been a very indecisive market, very volatile, very range bound. But ultimately, we might be looking at a break above the 71 level as a signal for us to perhaps enter into a bullish trade. So what we would do ultimately is we would look to buy that call option around that 71 strike price. But in order to offset some of the costs, we could sell off a call option up at that 74 strike price. So what this does is it allows us to capitalize on a move from 71 to 74, but at the same time we lower our cost basis, which means that we don't have to put up as much capital. It also means that our break-even point on the trade is a little more manageable as well. So to illustrate that, let's just take a quick look at the dynamics of this position. So we're going to buy, the EUI is sitting at 71. Okay, we're going to buy one September 71 call option. And when I was putting this presentation together yesterday, the 71 strike September call option was asking $1.72. So that means that we would actually have to pay $1.72 or $172 per contract. So that, of course, would be a debit to our account. Now, at the same time, we would look at the September 74 call options, and the September 74 calls have a bid of 74 cents, ironically enough. And so as in selling that September 74 call, we actually have a credit deposited into our account of 74 cents or $74. So what happens is we reduce the net cost of that transaction by 74 cents, which means we only have to put up 98 cents in order to participate in this particular outlook. Now, the trade-off, of course, as I mentioned, is that we cannot make any more than the strike price that we sold. So our profits are limited between to the spread between the 71 strike and the 74 strike, less the cost of the premium that we're actually having to pay out. But what we've done, if you'll notice, is instead of our risk being $1.72 or $172 per contract, we've lowered our risk down to 98. So we've in fact created a position where we have we've limited our risk exposure, but as a result, we obviously limit our profit potential. Now, here's just a typical risk graph that we would look at, and this is applicable whether or not you're looking at these FX options or whether you're looking at equity options or what have you. But what we're looking at here is essentially a profit and loss graph of that particular strategy, and the potential profit should the pair value, should the EUI actually trade up 274 and beyond by expiration, is in fact $202 per contract, and this is after we factor in the cost of our initial the net cost of our initial spread. Our maximum risk is $98. Our maximum reward, after we consider the cost of the position, is $202. So you can see that we have a little better than a 100% profit potential on our risk should the actual pair do as we've expected. Now, our break-even point in this scenario is determined to be 71.98. So in other words, the pair value needs to be trading on expiration at 71.98 if we are, so almost 72, if we are to recapture the cost of the trade. Anything beyond that becomes our profits. So if we think about the consideration of just buying the call option just by itself, we would actually have to add $1.72, I believe, was the cost of the position. We would actually have to add that full premium to the 71 strike, and that would, of course, increase our break-even point significantly more, which means that we need to see a bigger move in the underlying pair value in order for us to break even. Now, we can sell off this position at any time before expiration. So even though I suggested that these options are European style exercise and that there's no forced settlement until the end of expiration, that doesn't mean that we can't close out our positions when we want to. We can buy and sell these option contracts at any time before that expiration date, which means that if we find ourselves in a profitable position and we've actually been able to generate a higher, a fairly respectable percentage of the profits within a short period of time, well, we can sell off the position. And of course, if we have multiple positions, well, we can sell off a portion of the positions at any point and hold the remaining portion of our position into expiration to see if we can capitalize on the full amount. Now, if we're looking at participating from a bearish perspective, of course, the typical approach is to use a put option as a means of trading a directional view to the downside. Now, of course, first of all and foremost, our outlook must be bearish, so we need to have some means of establishing that directional bias. And from there, what we're going to do is we're going to purchase one put option at a strike price that we're comfortable with, so it could be an at-the-money put, and we're going to subsequently sell off a lower strike put option and collect the premium. Again, we're going to do this on the same pair value, and we're going to use the same expiration date. But just that to plant that seed of gain, if we have a bigger picture outlook on the particular pair, if we think, let's say, for example, the U.S. dollar is going to strengthen against the euro over a 6-month period, what we could do is we could buy a 6-month at-the-money call option, and every month we could sell off an out-of-the-money call option to collect that premium, and that's what we refer to as a calendar spread. But the principle still applies, and the same goes for a bearish outlook as well. If we decide that we are bigger picture bearish on the U.S. dollar against a particular currency, we could buy a longer-term put option and then sell short-term out-of-the-money puts as a means of generating some cash flow against that long put. And of course, every month that option contract expires, that actually goes against paying down the cost of our long put.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.